Hello, everyone, and welcome to BFW 2401, Week 10, Lecture 10. Today, we are talking about very interesting topic, which is the off-balance sheet and derivative businesses in banking. Now, we don't find a lot of off-balance sheet business and corporates, but we find it a major item and the major item that generates risk in banking. Today, we are talking about the off-balance sheet items, and they are actually can be classified into two main parts. One part is what we call off-balance sheet items, and we call it non-market related items. And the other one, which is the derivatives, which is market related. Now, we will talk about this later on, but as we proceed, I want to mention this issue from now. When we talk about non-market related, that means if I'm issuing a loan commitment. Now that loan commitment will stay as loan commitment until it's materialized. Now, if the customer withdraw the loan, then it will move from on balance sheet, which is a commitment, which is a promise, and become an asset later on. So the changes, the value of the loan itself does not change. But when we talk about forward contract, we call it market related. What do we mean by market related? Means if I have a forward contract for exchange rate, now that forward is actually protecting me or hedging me against the changes in the exchange rate. So if the exchange rate keep changing in the market, the value of the contract and the value of my exposure will keep changing. Look, this is unlike what we have in the loan commitments. So in the loan commitments, we have what we call non-market related items. And when we talk about derivatives, we talk about market related items. One more issue to mention before I share my slides is that I divided this lecture into two parts. The first part, I will talk about the OBS, which is off-balance sheet item, which is non-market related. Later on, we will talk about the derivatives in part 2, and which is the market-related items. And we have few derivative contracts, we'll talk about it. Now, having said that, please allow me to share my slides and proceed with part 1. Okay, so this is actually part 1. And this is the common thing we have always. So we are actually talking in week 10, as you can see. We are talking here, and we are talking about financial derivatives and actually risk management tools, which is actually the financial derivatives. But within the financial derivatives, we are talking about the off-balance sheet items, and this is actually week 10. So to move from here, one more thing to mention about it is that when we talk about derivatives, there have been new what we call international accounting standards that ask us now to report the equivalent price, the equivalent value, to report the equivalent value of the off-balance sheet items. Before that, we were talking about the face value, which means if we are issuing now, if we are making a contract to hedge, say, a value of $10 million for the exchange rate. Now, if the changes in the interest rate between 1% and 2%, that is the credit that that is the risk we are exposed to, and that's what we should report. Other than that, we don't report the first value because it will actually enlarge what we call our financial statements unnecessarily. So this is just one item to mention it. The other thing is I want to talk about the references. Actually, I'm talking about our book, which is you can find this in chapter 16. But I actually introduced the financial derivatives and the off-balance sheet items, and I gave more explanation here. We have also, this is, for example, in Malaysia, if we want to see the derivative market, If you want to see the derivative regulations in Australia, you can look for EPRA. And if you want to look at this issue deeply later on, maybe you consult this a book 1989, which is a new one, but it's a good guide to risk management. I think as far as we are concerned, I think the slides should cover necessary things. If you need to look at the book, please do that. So the learning objective, actually, we want to discuss the derivatives and off-balance sheet items, as I told you. We want to identify the major types of off-balance sheet items and describe the main features, which now we are talking about the off-balance sheet. We will talk about the derivative instruments, and we will also know why banks actually are very concerned and very interested and very driven to trade and work with off-balance sheet items, simply because they make a lot of profits. So either we are talking about the trading the derivatives or actually collecting fees from the off-balance sheet items. Now, the importance of OBS, as I told you, is what when we want to know this is actually our agenda. We want to know what is OBS business. We will give some overview about derivatives, which is in the second part. And we will say why bank using derivatives. This is the second part. And then we will give an example of RA, and then we will conclude. Now, look at this, for example, when we talk about this is trends. And as I told you, whenever there is trends, you are not responsible to memorize or to be responsible about it for any test or any assessment. It's just to give you some examples. I was trying to separate it this time, but it's only a few slides. So it actually doesn't need to be separated in one recording or in one part. So the Australian banks, this is very old data. It can see from 1990 to 2007. Actually, there have been an increase from 4.9, 5. So actually this is the on-balance sheet items, which we know. Now we want to see how big is the off-balance sheet items, which is using the face value, which is huge number. This is 4,900%, 4,900% more, which means when we say 4,900%, which means we are talking about 4.9% times. So this is actually 4.9 times. We are not talking about this when we talk about 1995, it jumped to 5.5 times. But then actually in 2007, it was actually, if you look at the off-balance sheet item and the on-balance sheet items, you will find it around 5 times, which is 500%, 580% or something like this. I was also curious to know how is it in Malaysia. Malaysia is not an active market, and you can take it from banks, bank by bank, from their balance sheets. So I take it from Maybank from their balance sheet for the same period. Actually started from 2004 to 2011. Australian were actually working until here, and they found it's only 27%, 26%. It's not really a big deal if you can see it here. It's here. So actually it's not very active, the derivative markets, and actually it's controlled by the security commissions. Which means this market also is developing. A derivative market is also very risky. Now, when we measure, as I mentioned before, when we measure the importance of OPS, we have to look at the face value. We don't take the face value, but actually we are talking what we call the equivalent, credit equivalent. Look, for example, this is a contract of 1 million OPS. If you take the 1 million the face value and you report it, you will overstate the bank exposure to the losses. But actually, an alternative way is to look at the credit equivalent. So if we think, if this is, for example, an exchange contract or interest rate contracts, and we think the changes in the interest rate will be between 1.5 to 2% up or down, then that's what we report, 1.5 or 2%. And of course, this is according to the movement of the exchange rate historically. Now, let me go to another example here. When we talk about the off-balance sheet items, as I told you, the non-market related. When we talk about non-market related, please understand it. Non-market related mean you can talk about loan commitment, you can talk about credit equivalent, which means bank guarantee borrowers in the market, bill endorsements, you can talk about services, you can talk about so many things that has a fixed value. It is exposure. It is not reported, but if something wrong happened, it will be a liability in the future, or maybe it can be an asset if it is a loan commitment. So that one is actually, if you take the value, the gross value, for example, here in Australia, it was 537, and 2000, when we reported from the book, 537 billion. When we have it, the equivalent, which is the real exposure, is 138, which is 25%. But when we come to derivatives, the difference is huge. So derivative market, for example, this is 5.05 billion. We have only 992 billion, which is actually 1.8. So as you can see now, the exposure is different from the face value. This is actually just to map your thinking and your mind in this issue. And actually, I have divided into parts. Now, the first part I talked about the off-balance sheet transaction. Now, this is the non-market related. And then I talk about the derivatives. When you see derivatives, you know it's market related. So now the off-balance sheet, we have, it is non-market related, as you can see here. And actually it generates revenues. And mostly it is guarantees. And it is actually promised to be in future balance sheet item. Now, it has a risk. The risk we can have in this item is liquidity, credit risk, interest rate risk, and operational risk, which means when I issue a guarantee. Now, the guarantee, say a guarantee, a performance guarantee, which we'll talk about it in a minute now, but it is one of the off-balance sheet items. This, for example, guarantee, for example, a contract, a corporation like, a huge corporation like Sunway, interested to build 5 SMRs, for example, new SMRs. Now, everyone maybe cost 100 million ringgit. And if you do that, maybe they want huge ones. So they will make, they will ask contractors if they are not going to do it, or they are not going to do part of it, they will ask contractor to make bids. Now, when you do bid in this country, either for the government or the private sector, the third party who owns the business, who owns the work and who will pay, usually will ask from the contractors a bid bond. And the bid bond is like a guarantee. So for example, it is around 5%. So if, say in this example in Sunway, if they issue, for example, 100 million, they want to build a huge SMR for 100 million, for example. 1 meter around, 1 square meter around, I think 1 square feet, I think 1,400 ringgits in Malaysia. So anyway, if you ask them for 5% of the 100 million, maybe it is 5 million. So you can go to the bank and the bank will issue you that guarantee, saying that my customer, I guarantee my customer for 5 million. And this money will be withdrawn based on the request of the third party, which is Sunway. Now, Sunway will, for example, they like your bid. They do the contract with you, and they started, paying you to work. But maybe you decided at the end, because you find a good opportunity, that you are not interested in it. So you just want to withdraw. If you withdraw in this case, because you take time and effort, and Sunway cannot do this, announcement again and bring contractors and open all those envelopes and bids and discuss them. So in this case, if you say, no, I'm not interested after everybody left, then in this case, Sunway may confiscate this guarantee. Now that guarantee, this is our case now. This is an off-balance sheet item. When that guarantee was issued by 5 million, and it was reported as a note to the balance sheet, if we are reporting it in the balance sheet, that we have off-balance sheet item of 5 million. But that doesn't mean that will materialize. It's only when if the cost of our client, our customer, breach the contract with the third party, which means he said, no, I'm not going to take the contract. Sunway will write to the bank to confiscate the guarantee, and they will take it for them. In this case, you have to pay to Sunway, and then it becomes liability. See, now it moves from the on-balance sheet to the off-balance sheet, only in this case. So in this case, actually, that will create a liquidity problem. You have to pay 5 million to Sunway, and you have to follow your customer for this credit. Maybe you give him a loan. Maybe you issue a loan, and it will be an asset. So, and you pay for Sunway. So it will be a loan for your customer. That loan will have credit risk. And then if the loan changes, it will involve also interest rate risk. And then you have to follow that loan, it's operational risk. So you can see now, it's not like issuing guarantee and it's the end. It's a long, it would just incorporate so many risks on that. Now, so many risks, I mean. So having said that, you can look to the other items in the same manner. So they are guarantees. This is off-balance sheet items. Now, some of them guarantee for direct substitutes. What do we mean by direct substitutes? I will guarantee, because the bank is using its capacity within this trust economy, because everybody trusts banks. If A want to borrow B, but A actually does not know B, it doesn't know him financially, it maybe know him in person or whatever. So they will ask C to, they are worried about credit risk. So they will ask third party, whom both of them trust, which is the bank, to issue a guarantee. So the guarantee in this case, the bank will say, okay, I guarantee B to pay 1 million, for example, ringgit end of the year. So now A will pay to B the discounted amount of 1 million that will be collected end of the year. And hopefully B will pay at the end of the year, and there is no problem about this. But now if B end of the year default to A, which is the discount, the borrower, the lender, then in this case, A will follow the bank and collect from them. So all of those payments, which has to be paid, like documentary letter of credit, like other direct credit substitute, which means there is a payment, it has to be paid, either to be paid by the bank or to be paid by the customer. The bank will pay only, and the customer will not be paid, will not pay. So the payment will happen anyways. It just who will pay it. We call this direct credit substitute. But we have another one called performance and trade related contingencies. Now the performance and trade related contingencies, it's like the guarantee of Sunway. You do the guarantee. Maybe the customer is so nice. Maybe he take the loan, he take the work and start relationship with Sunway, or whoever is the third party is very well. The bank will hear nothing. Everything is just nice. So actually, there is no payments in the day. Here, there is a payment end of the day. Here, there is no payment, only a breach of contract. We call this performance and related performance, remember, performance and related contingencies and trade contingencies. Now, when we talk about this direct credit suit, we can talk about guarantees of payments, we can talk about standby letter of credit, we can talk about bill endorsement, and we can talk about withdrawn both options. All of this will involve payments end of the day. Of course, as I told you, there is a risk involved in those issues, in the guarantees on the or in the performance. It's a credit risk, liquidity risk, and interest rate risk, because if your customer default and you have to pay, you will go to all those risks, and you will be involved as a bank in those risks, including the liquidity risk. Now, examples of the guarantees, it can be documentary letter of credit or performance-related contingencies, and we'll talk about it. And the third part is the commitments. Now, the commitments, we already know it. One of them is actually the loan commitment. Now, the loan commitment, the customer may withdraw the loan, you issue a loan now, it should be reported in the balance sheet that there is a loan committed and to be paid by 2023, for example. But there is a possibility that the customer will not take it later on. This is one thing. The other thing is, whoever look at your financial statements, they're actually want to understand whether there is something is going to happen, whether there is any contingent liabilities or loans or type of commitments in the future. So they need to see that there is loan commitment that is due 2023. Also, you are in 2021, but you actually understand that there is loan commitments. Now, we are talking now about loan commitments, but if you have all those issues, those items can be crazy, and they are very important to know them to actually to see the risks. Now, we can have sales and repo agreement. And sales and repo agreement, we'll talk about it later in a while, but it's actually this with central banks when you sell your assets and you buy them later on. If you report within that time, while you're selling and you haven't returned them back, you have to show the others that actually you are going to pay to repurchase your assets or securities from the central bank, and it should meanwhile it should be reported under the sales and repo agreement. We have underwriting facilities. Underwriting facilities is a huge business in banking. So all those companies, the banks will take all those IPOs, all those bonds issues, all those type of issues by raising funds by companies. They usually go to the banks and they sell them the whole issue against some type of fee or discount, and they collect, and the bank will go and actually issue, for example, the IPO or the bonds issue or whatever. And then because they have this profile in the market, and they will collect the money, but they will pay you in advance. Now, regardless of this, when you are actually interested in, as a company, if I'm a company interested in making an IPO, but I'm not sure whether everybody will buy, or bonds, and then maybe I have problems with the the trust of the customers, I will go to the bank and I will tell them, can you be underwriter for this? If they promise me, this is for example this year, and I'm going to do it next year, during this time, I have to show it as a bank that I have underwriting facilities, and I have promised others to buy their IPOs or bonds issues or whatever. This is the whole thing of the off-balance sheets. As you can see, all those off-balance sheets are actually non-market related. All those contracts will not be changed in terms of values, whether the interest rate change or the equity market change or the exchange rate change. Now, let me talk, and this is actually part one of this lecture. Part two is the derivatives. Now, the derivatives, as I told you, all of those derivatives, we'll talk about it one by one, but actually those are the derivatives. We have forward agreements, we have future contracts, swap contracts, and options. And those ones actually are used to hedge either foreign exchange, gold contracts, interest rates, equity markets, and commodity. As far as we are concerned in this lecture and in this week, we are only interested on those contracts to hedge our interest rate exposure. We are not talking about gold contract, foreign exchange, or other one, only the interest rate exposure. Please highlight it here, and it's about this one, the interest rate in all those type of contracts. Now, having said that, let me move to the next item. Just this is very fast. We want to talk about an item called why we do it. Actually, because of business. Why we do OBS and derivatives? As I told you, because of business. 40% of the Australian banks' income is coming from this off-balance sheet business. Look how huge it is. And if you are smart in it, you just can make a lot of money. The other thing is the additional concepts. We have something called crystallization, and I think I have talked about it. Crystallization means when you issue, we don't record the face value, but the credit equivalent. So when the item moves from the on-balance sheet, from the off-balance sheet to the on-balance sheet, we call it, it has been crystallized. So this is the term crystallized, which I want you to be aware. The other thing is the exposure. As I told you, there is something called credit equivalent, and we have face value. We use the credit equivalent, so we don't overstate the value of the balance sheets. This is two items I want you to, before I go, and this is, you can read about it here, the crystallization. I think I gave an example here. Let's talk now about the off-balance sheet items. We have services, we have contingent claims, which is this one, the two of them, these two items. And then we have the commitment, which is the loan commitments, as I told you, the underwriting, the loan commitment, and the repo agreements. Here we have the services, but the most of the work is here. And actually, just for life, I want you to be aware of those items. They are very useful, even if you do business. If you know how to do letter of credits, which is important in exporting and use banks in that issue. If you know how to, get the performance, you can get it with zero margin sometimes if you are a good customer to the bank. And then this is actually, you can do a lot of business if you are interested in working in this area. Okay, so now let's go to the services. So services is actually on balance sheet. What do you mean by off balance sheet? Banks do so many things. For example, moving the cash from those ATM machines. And we know here we have a company specialized in this, but some banks, for example, will move the cash of the ATM machines around all those ATM machines for all other banks inside Kuala Lumpur or maybe overall the country. Now they get fees for that one. But what if the money was robbed or stolen or damaged or anything happened to those, to the money? Then in this case, actually, or misused or, so in this case, actually, it is a liability. So you have to report that you are doing services and the amount of, daily amount, whatever you can issue, how much is your commitment or your average commitment during the year for this item. But they can issue, they can have transaction cost. Credit cards also they take interest, but actually credit card comes under some type of services. We can act as a broker. So all of those actually you can collect agency fees. We can take commissions. We are talking about brokerage commissions for those services. We can talk about brokerage fees if we are talking as brokers. And we can take also other services or fees. So all of those actually collected from the services. As I told you, sometimes you can run what you call asset management. This asset management services, you know what asset management? Asset management means, and Malaysia, all Malaysian banks are doing all of this. So they actually run funds. So the fund, for example, established by Affin Bank and run by public bank. So public bank will run the fund because they have the expertise they have good managers, whatever, but actually they are collecting fees and commissions from Affin Bank or some other banks. And you can see all those funds are around, all around the place, and all those banks actually running funds and what we call asset under management for other banks. This is good, but where is the problem? The problem is this. If you did not pay enough professional care in dealing with those funds, and the third party could prove that you didn't do any professional care, you didn't pay any reasonable and required professional care to keep the assets and to manage those assets and the management. So in this case, you will be liable about this. So asset under management is a figure that may include in the off-balance sheet items. It's only the bank itself has no direct claim to those assets. As I told you, if something wrong happened by the bank, by the employees of the banks, actually, by the managers that are assigned by the bank who is running this asset under management or this fund for some other banks, and they didn't do it well, and they lack professionality in doing it, which we call due professional care is not there, and if it can be proved, of course, by lawyers and all this, then actually there is a liability item here. So this can apply to the brokerage, this can apply to the cash movement, this can apply to so many things that the bank actually collecting fees and brokerage and commissions for it. Okay, let's go now to the, this is the direct credit substitute. As I told you, this is the most important item, the direct credit substitute. And we have talked about it a little bit. So we are operating under this trust economy. And when we talk about trust economy, we trust banks and we think they are guaranteed by the governments. Even if they are not guaranteed by the governments, if people actually would trust banks if they give guarantees. So for example, if B want to give a loan to A, which is the borrower, and this is the lender, but the A should be make the repayment, but B actually the lender has very risk averse, and they want to avoid any credit risk, so they ask A to bring them a guarantee. So the A will pay a fee, and then that fee will go to the bank, and the bank will issue a guarantee. The guarantee says, if B does not pay to you, I will pay to you. Then banks are so smart. They use this reputation and they use this trust economy to generate huge fees. They are not using their money in their loans here. They are just collecting fees because of the trust they have. This is one of the things that you have to be aware of. And this is the whole concept behind the direct credit substitute or performance. This is behind the direct credit substitute, which means end of the day, and when this loan given by B matures, A has to pay. If he doesn't pay, B has no worries because the bank will pay him. This applies to guarantees, standby letter of credit, bill endorsement, and written option. Let me tell you what is the standby letter of credit, which is a guarantee. Now, this is very interesting. We can use, this is just one use, but you can use it in so many things, international, importing, you can do it in so many things inside within the cycle of the business. See here, for example, they can issue a standby letter of credit. If you want to issue a bond, if you want to issue bonds, for example, and if you want to issue bonds, in this case, maybe the issuer is not well rated in the market, but they will still want to sell it. So in this case, they approach to the bank will issue what we call standby letter of credit for all those creditors and all those investors, not in them, but they know that the bank has issued within the documents of those bond issue that there is a standby letter of credit. This standby letter of credit say if the issuer doesn't pay the interest and the principal, the bank will pay it. So as you can see, this is a standby letter of credit, which is actually a guarantee, which means this is a payment. It has to be paid by the issuer. If it doesn't pay by the issuer, there is a guarantee that will be paid here. Now, this is one. The other one is, this is a very famous one, which is the bills. Now, bill endorsement, this is the bill. Don't worry about all those figures. It's just, this bill is a document. And let me tell you what is this bill. This bill is a document, and this document actually is issued by a borrower. Now, the borrower, we call him here, is a borrower. Now, he wants to issue it to somebody who is an investor, which we call him in this context or in these settings, we call him discounter. So this is a promise of paying 100,000 in 28th of December 2021, and maybe he issued it in 28th October of 2020. If he issued it in 2020, and it will be measured into 28 December 2021, they will discount it here. Maybe they will discount it according to the discount rate they agree on. There will be a fees. There will be some discounting. And in this case, the discounter also, maybe he will pay now 95,000. So he will receive 100,000 after 1 year. So he's getting around 5%. Now that 5%, but he also need to avoid any risk. So he will ask this bill to be stamped, which we call endorsed. By whom? By the bank. So if they endorse it, the bank, end of the year now, on 28th of December, usually what happened is the borrower will contact the bank, receive the 100,000. The drawer, which is the borrower, will pay to the bank the 100,000, and the deal is finished. As you can see now, it's not the money of the bank, but it is actually the money that is to assist the lending within the market. This 100,000 can be 10 million, 20 million, 50 million, as long as the bank will endorse it. And somebody would say now, and why the bank will endorse the bill? Because they will get fees, 1% or 2%, which means this guy will pay 5% to the discounter, and maybe 1% or 2% to the bank, depends. And he has to decide whether he can take it or no. So, but the fees will be part of the transaction. This is the bill endorsement. So actually, we talked about the guarantees, standby letter of credit, bill endorsement. We didn't take here about the written option, but we will move now to the next part, which is this part, the performance and related contingencies. Now, the performance and credit related contingencies, please look at this. We have two. We have one called documentary letter of credit, 2 items, and the other one called performance related contingencies. Now, this is a very, very famous thing. And if you are in banking and you are doing very, international trade or whatever, please understand that, which is the documentary letter of credit. It's like a guarantee here. So what happened is, look, this is, for example, don't worry about all these issues. It's just very easy. If I want to import some type of machines from China, say, no, I want to import, say, 5,000 items of Huawei. Now, in this case, I will talk to Huawei company in China. This is a good phones, whatever. Then in this case, I will talk to the foreign exporter. This is Huawei company who is manufacturing those phones, what you call smartphones. And here the Malaysian importer, whoever he is. Now, in this case, what happened is, after you agree, the first thing the foreign exporter will ask you, open an LC, which means letter of credit. So in this case, you will open an LC, and you can see the steps now: 1, 2, 3, 4, 5, 6, 7, 8, 10. This is the transaction. So if the Malaysian bank, the Malaysian importer is working with public bank, he's a customer of public bank, and the foreign exporter is Bank of China. So the Malaysian exporter will ask public bank to open an LC. So in the first issue, the Malaysian importer will ask an order, right? For example, he will place an order for 5,000 phones. Now, number two, he will go and ask, because it's ask Malaysian bank, say it's public bank in this case, to open an LC. They will open an LC and they will inform the foreign exporter, number three here, that they already opened the LC. Now the foreign exporter can start manufacturing without receiving the money. That's fine. He will start manufacturing the goods, which is the 5,000 phones, and just he will ship them, no problem. And when he ships them, he will receive the money. But now let me go what would happen after three. After number three, the foreign exporter will send the products. And in the same times, he will go, because he will go and bring these documents to the foreign banks. For example, Bank of China. Because when they open the Malaysian banks, when they open the LC, they already informed the foreign bank that there is they open an LC for your customer such and such for 5,000 phones. Of course, copy of this already gone to the exporter. So the exporter, when they ship the goods, they will have something called bill of lading. Now they will take the bill of lading, the bill of backing, all those documents, Chamber of Commerce stamps, invoices, whatever. It's a package of documents, and they will send it to the foreign banks. They give it to the foreign banks. Foreign banks will give you the money. Foreign banks will actually send those products, or send those documents. Actually, they will give the money, but they will send the documents to the Malaysian banks. Now, the Malaysian banks, either in that moment, they can send back the money, which is actually for the cargo. So in this case, they will send the money. The money will go now to the foreign exporter. As you can see now, after they ship, they will provide the documents, and actually they will receive the money in the same moment. But if you can look at here, because the foreign banks will send the documents here, the documents will be received by the Malaysian bank. Malaysian bank will send the money. The money will go to the foreign exporter. Foreign exporter now is done. Foreign exporter is done. Foreign bank is done. Now it is between the Malaysian exporter and the Malaysian bank, the Malaysian importer and the Malaysian bank. So now the documents have to go, as you can see, to the Malaysian exporter. So the Malaysian exporter has to pay first, has to pay for the cargo and receive the documents in number 10. All of this is actually mentioned here. But somebody would say, why? What is this document? You cannot discharge your goods in the port until you have the bill of lading and the other documents. And these documents are sent actually by carrier, which is this fast mail sent to the Malaysian banks. Now, the Malaysian banks is the one who imported. When he receives the money, he will give you the document. Now you can go as Malaysian exporter to the port and take your cargo. If you are exporting as a Malaysian, you become Malaysian exporter, you can shift this one. But what I want you to know is that this is the process of the what you call documentary letter of credit. Somebody would say this is actually easing the international payment. Yes. Can you use online? Yes, you can use online. You can use wallet. But if you are actually importing 30,000 tons of wheat or 5,000, these huge amounts, this only can be facilitated by banks. You are importing, for example, 1,000 cars, huge machines or factories. So in this case, actually, you cannot, banks only do it through those LCs. These online platforms actually for small, the trading, whatever is actually for small transaction. This is for huge transaction, and it facilitates the international trade. Now, somebody would tell me how that is related to OBS. I will tell you. If Malaysian bank has to pay, until number 7, the Malaysian bank has to pay. If the Malaysian importer default, now it's a liability. Now, if the Malaysian importer did not pay and did not get the documents, of course, the cargo will stay in the port and forever. And you will have to pay demurrage and fees for the port and all these things. And you have to pay. Now, this is actually, OBS has crystallized as a liability. This is why we say it's actually what you call a guarantee. It's a documentary letter of credit coming under performance. You will believe that the customer actually will pay. Now, a performance guarantee is different one, and performance guarantee is like the one I explained to you about the Sunway and the contractors. Remember, documentary letter of credit actually has payments. You have to pay it end of the day, but they bring it in the classification here under what you call performance and trade. Call it trade-related contingencies. And the trade-related contingencies is actually the LCs, the documentary letter of credit. Just to documentary letter of credit. As you can see, it involves risk, credit risk, liquidity risk, and interest rate risk. And it is actually here. Now, this is the performance. And as I told you, this is a guarantee just for performance. And you can have those guarantees for so many things. You can have it in trade. You can have it even in civil life. You can have it even in legal, for legal issues. You want to get somebody from the prison. You want to do anything, people ask for guarantees always, as long as it is from the bank. So if the contractor, as I told you, if this is Sunway, ask from John, giving him business to build, for example, a house. Now, he wants to build a house, but does not know the contractor. So in this case, John, for example, will ask the contractor to do that for him, but he will ask the contractor to provide a guarantee. The contractor will go to the bank will guarantee John that the contractor will do the business as per the contract. If he breached the contract, then John can actually the guarantee. Now, John likes Sunway before, as we talked about it. This is commitment. This is maybe the last slide. So the commitment, we have sales and repurchase agreement. This is actually the promises of the bank to, facilitate their liquidity, and they sell the securities to the bank, to the central bank, but the central bank does not need the securities. They just want it as a collateral, but you promise them to buy them later on in 1 month time or 2 months time. So it's a promise, and you have to report it as a commitment. Outright forwards, this is actually a bank promises to buy or sell bond or an agreed future time. Bank promise to buy or sell an amount of foreign currency at an agreed price and future time. So this is actually outright forwards. So in this case, there is an exposure for these issues. This looks like, it's some type of commitments. So you have to buy or sell at an agreed price and future time. So this price, you have to be, it will not be changed actually, and you have to buy it in the future. So before that future come, you have to report it as a commitment. Underwriting facilities, as I told you, banks promise to buy bonds or IPOs in the future, so you have to report it. And then the loan commitment, which is a loan that you have to issue in the future. I think the commitment is very straightforward. End of the day, please look at this, and we have covered all those issues. This is off balance sheet. One more thing before I conclude here, this is all of them non-market related. Thank you very much, and this is the end of part one. Let me stop sharing and say thank you, and I will see you in the second part. Bye-bye.